Well, China's central bank, the People's Bank of China, announced on Saturday to cut its key rates from Sunday to ease deflationary risks. This is the second round of key rate cuts in 3 months and the first in the new year, underscoring continued downward pressure on the world's second largest economy. However, analysts say the rate cuts does not mean China is changing its monetary policy. Let's take a listen.
China's central bank on Saturday decided to cut benchmark interest rates by 25 basis points amid deflation worries. According to the PBOC, from March the 1st, the one-year loan interest rate will be lowered to 5.35%, while the one-year saving rate will drop to 2.5%. The central bank also decided to allow more flexibility for the interest rates. The ceiling for the floating range for the saving rate could be 1.3 times the benchmark rate, instead of the previous 1.2 times. Analysts say the focus of the latest rate adjustment is to keep real interest rate levels accommodative to the changing fundamental trends in growth, inflation, and employment.
This round of rate cuts is a fine-tuning to accommodate the monetary policy to the fundamentals of market. But looking overall, I think China will stick to its prudent monetary policy, and the prudent monetary policy will continue.
China's economy grew 7.4% in 2014, the weakest annual expansion in 24 years. And a string of domestic economic activity was likely to remain sluggish, while external demand looked uncertain. To try to stop the economic slowdown, China cut interest rates in November and lowered the reserve requirement ratio for banks in early February. But the protracted slowdown came amid subdued price levels in the country, which gave leeway to the government to further ease monetary policies if needed. The rate cuts will bring down the cost of private financing, ease business pressure, in turn help stabilize growth.
Due to the economic slowdown, companies are facing challenges of declining profits and surging financing costs. The rate cuts will channel money into investments, decrease companies' financing costs, and encourage consumption, so it is necessary to cut the rates.
Analysts say the move will also help reduce debt risks and ease deflationary pressure, but whether it will significantly address the slowdown remains to be seen. China is expected to unveil its growth target for 2015 in the government work report on March the 5th. Analysts expect the goal to be set at around 7%. Li Chong, CCTV.